Okay, now for the first one here, if fixed cost is the same, then that means producing each pack, what really matters is the variable cost. Okay, meaning that fixed costs, if you produce more products, it's just spread along each and every unit at a lower cost, but altogether the total fixed cost is the same. Okay, so what we really need to compare is whether the 41 cents per pack, that revenue you're generating, covers the variable cost per pack. So from the table over here, what is the variable cost per pack? It's variable overhead is 12 cents, but there's also direct materials, meaning that the more you produce, you have the more materials. So altogether, you have 0.13 plus 12 cents, and also the direct labor, add them all together would be 31 cents. This is the variable cost. Okay, so if fixed cost is the same, we don't have to worry about that. Just need to compare whether variable cost is higher or lower than 41 cents. So this actually is lower than, the cost is lower than the revenue you're getting. So for each and every one of them, you're generating 10 cents of profit, right? Because your variable cost is 31 cents, your revenue receiving for each and every pack is 41. The difference is here is 10 cents, which is the operating income, or you could say the contribution margin you're generating from this particular sales order. If you actually accepted, the increase in revenue would be given to you from the problem, multiplying 57,000 packs by the 41 cents will give you 23,370. Then the cost, the incremental cost that you're spending to produce this special order, again, the number of packs multiply the variable costs. Remember, variable cost goes up as sales orders increases. So that is the floating cost that will go up along with sales. So after subtracting this from sales, you can determine that, okay, for this special order, if we do accept it, we're generating profit $5,700. Okay, if we already, this number one here, we assume that fixed is the same. So what does that mean? That means that even though per pack fixed cost right now is assigned as 30 cents, assuming that right now you have 30 cents multiply the current production you already made, assuming, then you have 30,000 fixed costs, but now if you have additional pack, you're just dividing it by more units. So fixed is already fixed there. You already spent that cost. So regardless of the orders that you have, as long as it's within a specific range, it's that cost over there for all of them. Okay? Exactly. So how did you factor that in? Adding to this. Okay, so it has to be somewhere in the middle here, right? You consider variable cost, and then if you have additional fixed costs occurred specifically for that order, so if we go back to the copier example, perhaps you need to purchase additional machines. For this order, if you need to incur additional machines or techniques, fixed cost, specifically for this order, then overall you're actually losing $200 after accepting this. So the decision here will be rejecting this special order. Even though it covers variable costs, but if you are, right now the capacity doesn't allow you to produce this many packs and you actually need additional costs spent for this, overall you may not decide to accept this because you still have fixed costs incurred additionally.
Would you accept it if it was like a year with you were always going to get like even if you're at a loss now, they're going to
If in the future you expect that the sales is going to increase, this particular special order will lead to a demand in the future, then that will be another case, yes. So this is a simple case assuming that currently the demand is stable for this particular product. And now if you have a special order, larger quantities or a different design, will allow you to spend more money here but doesn't really affect in the future sales, then you will have to reject it. But if this is something that is demanded from the market, later on you expect it to grow, then this will be considered an investment that you're doing. You probably will change your decisions, yes. But that's in a more complicated setting, okay? Okay, any other questions? Now, a lot of the examples given in this chapter here, we're just assuming that the more we produce, we're actually able to sell the quantity that we're producing. Because remember, this is an intro class, so we're still keeping all the settings at a very basic level. But of course, factoring in other advertisement costs, marketing costs, the demand from customers, a lot of these decisions may be changed by other considerations. Okay. But the general rule here, of course, the first question you need to ask in the company whether to accept this order or not, whether you're actually able to complete all the products on time. Second would be cost revenue analysis. If cost exceeds it, then you don't have to accept this. If the revenue exceeds it, then of course you have the reason to accept the order.